The last 2 years have been a roller coaster ride for equity investors all around the world. We had the COVID shocks and subsequent lockdowns. The Chinese markets have regulatory interventions. The Europeans have the Ukraine-Russia war. The Sri Lankan stock exchange has been sporadically closing. And with the US Federal Reserve hiking interest rate, it sure is making the global financial markets quite jittery. So a lot has been happening, and for people who are new to investing in equities might also find this very discomforting. And so in this video, we shall put forth 8 principles of equity investing that have stood the test of time and have helped investors make superlative gains. These principles have helped me immensely over the years and are equally applicable when investing directly in stocks or via ETFs, actively managed mutual funds or index funds. So do pull up your notepads and let's begin. Like everything in life, investing too needs a strategy. And if you're putting up capital in the equity markets without a plan, then it is not likely to be a profitable endeavor. Now, strategies can be of many types. In case of mutual funds, it's about how you allocate your capital across asset classes, passive funds versus actively managed funds, and how disciplined you are as an investor. In the case of stocks, there are a lot more strategy options. Growth investing, income investing, value investing, what else? Trend following, momentum strategies, swing investing, index investing, etc. Now, while I use the word strategy, a lot of it is also about the kind of investor you are. In fact, my own equity investing strategy revolves around keeping it simple. So firstly, I invest in actively managed mutual funds and index funds in a 50-50 ratio, which is generally in the large and mid-cap space. Secondly, I research and invest in mid-cap and small-cap stocks of growing companies which are available at reasonable valuations and have wide economic moats. And thirdly, I invest via ET Money Genius, wherein I have active SIPs in the growth and high growth portfolios. So every rupee I put in is built around these 3 areas, which kind of fits in well with how I operate, how I take risks, and how I want my money to grow. So remember, when investing in equities, always have a strategy in place and know what kind of investor you are. Investing in stocks means dealing with volatility. Notice I use the word volatility and not risk, and that's because these 2 words are very different, yet people think of it as the same. To put it simply, volatility is the up-down movement in the price of a stock or the NAV of a mutual fund, and risk should be looked at as the chance of having a permanent loss of capital. In our view, volatility is something that cannot be avoided. And for many successful investors, it is the volatility in stock prices that presents them with wonderful opportunities to buy low and sell high and consequently make a lot of profits in the process. Now, while volatility is always going to be there in equities, there are a few ways of managing it, at least on a portfolio basis. One of the simplest way is to invest via SIPs or systematic investment plans that inject money into equity markets at regular intervals and therefore help in smoothing out the ride. A second way of controlling volatility is by taking care of your asset allocation, which not only requires you to tactically divide your capital across different asset classes like equities, gold and bonds, but also within equities, one would need to look at splits across large caps, mid caps, small caps, momentum stocks, value stocks, international equities, etc. This part can be a bit complicated for retail investors, but if you like the thought, then do explore ET Money Genius that does all the hard work around asset allocation and rebalancing. To know more about Genius, do watch these videos which are available in English and Hindi, and the link of which is attached to this video's description. There's an old quote that says, making money is easy, keeping it is difficult. And it's not just the logic, even the mathematics supports that. For instance, if your portfolio were to fall by 30%, then a subsequent 30% rise in your portfolio will not be enough and one would still come up 9% short. And which is why building the necessary protections around one's equity portfolio is a must-do for all investors. So what are these protections? Number one, always diversify. In fact, there is a beautiful line that says, while concentration builds your wealth, diversification protects your wealth. But that doesn't mean one has to go hammer and tongs with diversification. In fact, just having a proper mix of large, mid, small cap and international funds should be sufficient. And if you're into stocks, then a mix of 15 to 20 stocks should give you the adequate diversification. The second way of protecting your equity portfolio is by rebalancing. You see, over time, some part of your portfolio will get lopsided, and that mostly happens due to expensive valuations. So just like how a car driver gets his vehicle back on the road, it's the investor's responsibility to rebalance so that the portfolio readjusts accordingly and gets back on track. And the third protection strategy one can use is a stop loss, which is a sort of a forcing function that instructs your brain to take a hard call. For instance, when I invest in stocks, and although I put in hours of research, I still have a mental stop loss of 30%. What it means is that if that stock I bought falls by over 30%, when let's say the market has fallen by 10%, then I force myself to assume that I might have made some mistake in my research and I forcibly exit my position in that stock. In other words, it's my way of saying sorry, and having that stop loss not only protects my portfolio from any further slide, but it also allows me to dust off my clothes and move on to the next opportunity. A prime difference between investing in a debt instrument like a bond and investing in an equity investment like a share is the number of assumptions one has to make. In the case of bond, it comes down to assessing the probability of the bond issuer paying the interest and premium, which is mostly a function of the profits made. However, when we work with equities, the number of assumptions are almost unlimited. One has to assume the revenue growth, the profit margins, industry dynamics, market share, debt levels, competitors, past valuation, current valuation, future valuation, and a dozen other variables. And that's where keeping a large margin of safety becomes important. So technically, a margin of safety can be explained as the investor's downside risk protection when he or she purchases a security at a price which is significant below its intrinsic value. In other words, a large margin of safety not only protects you from some assumption risks that you might have made in your analysis, but it also improves your chances of earning higher returns while taking a lower level of risk. Or as I would say, to the absolute discomfort of my finance professors, lower the risk, higher the return. Investment noise is the constant drumbeat of news, information, and tips that we are subjected to day in and day out. This noise comes to us via newspapers, TV channels, Twitter, YouTube, Instagram, our friends, and even our workplace. And as a firm rule, one should get into the habit of ignoring this noise to improve one's odds of investing success. Now, noise can be of three types. The first is what is called as unusable noise, which refers to information that is not likely to alter our actions or behavior. Say, for example, an earthquake in Madagascar or a political coup in Argentina. Secondly, we have untimely noise, which is information you are not likely to use in the near future, and the story could have changed dramatically by the time you are ready to use it. And the third noise is hypothetical, which is based on what someone thinks will happen. As you might have guessed, this is the most common type of noise and includes experts who continually talk about the economy or the stock markets. The point is, tuning out the noise is just a matter of habit, and what can come to your rescue is a clear investing strategy, your own experience, and the knowledge that one can extract from good books, some newsletters, and some of the more genuine YouTubers. So there are some factions who will disagree with what I'm about to say next. Lending companies will disagree, brokerage companies will challenge my logic, traders might call me dumb, and that's because it's our contention and advice that everyday investors should not use leverage to invest in the stock markets. You see, investing in equities is a speculative activity, and by taking a personal loan or using margin trading or options, etc., the investor ends up adding an additional layer of speculation on something that already has a fair amount of risk. In fact, no one can explain this better than Warren Buffett, who had this to say in his 2010 shareholders letter, and I quote, "When leverage works, it magnifies your gains. Your spouse thinks you are clever and your neighbors get envious. But leverage is addictive. Once having profited from its wonders, very few people retreat to more conservative practices. And as we all learned in our third grade, and some relearned in 2008, any series of positive numbers, however impressive the numbers may be, evaporates when multiplied by a single zero." History tells us that leverage all too often produces zero, even when it is employed by some very smart people. The advice here is simple. Always invest in equities with the money that you save rather than the loans that you're offered. I don't know who said this, but there's a quote that goes something like, "Never reply when you're angry, never make a promise when you're happy, never make a decision when you're sad." And in that same context, let's add another one which says, "Never invest in equities when you're emotional." Over time, many studies have been conducted that prove that most investors behave irrationally in different situations, which almost always leads to investment losses. In fact, one of the better literature on this subject is a talk by Charlie Munger, which is titled "The Psychology of Human Misjudgment," where he goes on to explain 24 different cognitive biases and how they force investors to take poor decisions. Now, an equity investor can take a few steps to control these biases and emotional factors while investing. Step 1 is to have a concrete investment plan, which then ensures that you stay focused on your goals and that you don't react emotionally to any kind of euphoric or despairing news. Step 2 for avoiding emotional distortion is to opt for a rule-based investment strategy, which can be done by using passive funds or when investing via SIPs. The third step in this process will be to diversify one's portfolio across different asset classes, which is something we have already discussed in this video. And the fourth and final step one can take to control emotions in investing is to understand market history, which can go a long way in managing one's expectations and in curbing any overreactions during a market downturn or peak. Net, I have said it before and I'll say it again, the biggest mistakes made in equity investing are not analytical but behavioral. So yes, do mind your emotions. Equity investing works best when it's done for the long haul. And yes, there will always be the temptation to book profits, take a punt, jump into a particular sector, a particular company, etc. But if you want to grow your wealth for the next few decades, you will need to have a long-term mentality and a plan to go with it. In fact, this entire long-term investing plan can be summarized in 3 simple phrases, which is invest early, invest regularly, and invest enough. So invest early is about getting a head start in the wealth building process and allowing the power of compounding to complement the original investment that you've put in. Simply put, the longer you are invested, the more time your investments get to bloom and to bear fruits. Invest regularly is more about discipline and how small amounts of money injected on a regular basis can build a lot of wealth over the long term. For instance, a simple yet effective advice to a 20-year-old will be to invest 3,000 rupees every month with an annual increment of 1,000 rupees every year at a 12% annual return, which would then grow his or her wealth to 10 crore rupees over the next 40 years. And the third phrase, invest enough, is about goal planning, which means one has to have a plan of action on one's income, expenses, future goals, savings rate, etc., so that your tomorrow can be as good or even better than where you want it to be. And with this, we come to the end of this video. You might have already read or watched some of the points that we discussed in this video, but we thought it was important to organize it in a single place with these 8 timeless principles, which I hope you found useful. If you liked the content, then do tap onto that like button, subscribe to our channel, leave a comment, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.